We started the year 2020 with a video on the Socratic way of investing, which amongst other things made us recognize the importance of looking at multiple angles to a problem or scenario. For instance, look at this table that lists the best performing capitalization type over the last 60 quarters. Of the 60 quarters on display, large caps have been the best performers in 24 quarters, small caps have been the top rankers in 23 quarters, while mid-cappers have had performance leadership for only 13 quarters. Now visually, this data should give us all the impression that the performance of large caps and small caps is much better when compared to mid-caps. But that's where the surprise is. Because if we ignore the quarterly performance and consider the entire 15 years, then it is actually the mid-caps that have performed the best with annualized returns of 15.6%. So there are always some biases, some visual tricks when we examine data and when we invest. And in this video, we shall, as ETMoney always does, aim to look at large caps, mid caps and small caps in different ways and means, with the objective of giving you a very refreshing perspective of what more one can expect from each of these capitalization types beyond the size of the companies. Let's begin. There was a time when there was no standard definition of what is a large cap, what's a mid cap, and what constitutes a small cap. Every fund house and equity analyst had their own definition of what these phrases might mean. Then it was in the year 2017 when the Securities and Exchange Board of India decided to do something about it. And it was in October of that year that they came up with a circular which clearly defined what constitutes a large, mid, and a small cap company. So now the first 100 companies by total market capitalization are large cap companies. And per the present list, that's a list that extends from Reliance Industries Limited, which is ranked 1, to Honeywell Automation India, that is ranked 100 in the large cap company list. Similarly, mid-cap companies are those companies that are ranked between 101 and 250, and small-cap companies, per the SEBI definition, are all companies that are ranked 251st or below. This list of which companies are tagged as large, mid, or small cap can be accessed by all investors from the Amphi website, which is revised every 6 months, and the link for which has been provided in the description of this video. Now, since the market capitalization of companies change by the minute, one can expect this list to be rather fluid, with companies moving in and out of their capitalization types. But as it stands, and this is just an indicator, companies over 30,000 crores in capitalization are large caps. The ones between 13,000 and 30,000 crores are mid caps, and the ones below 13,000 crores are small caps. Now, one might have also come across a generalization that large caps deliver a relatively lower return, but they also come with lower risk. In our view, this is borderline misrepresentation, and that's because of the phrase lower risk, which might indicate to new investors that large cap funds are safe instruments to invest into. Well, this is definitely not the case, as all equity investments come with considerable risk. And at best, we can say that large caps come with a relatively moderate level of volatility when compared to mid caps and small caps. Now, large cap stocks attract a high level of participation from mutual funds, foreign institutional investors, and the public at large, which in turn offers a lot of liquidity to these stocks. In fact, in numbers, Indian mutual funds own around 5.1% of the outstanding shares in large cap companies, with a sizable participation from domestic and foreign institutions as well. And finally, from a governance standpoint, large caps have shown a lot more shareholder discipline as compared to mid caps and small caps, which are mostly promoter driven. Additionally, moves made by mid and small cap companies often escape the public eye due to fewer analysts covering these companies, which makes it all the more important for investors to be careful and conservative with their estimates on these companies. Now remember, I had said earlier that a lot of investing relies on opinions, biases, confirmations, and some visual tricks. And making generalizations about large, mid, and small cap companies isn't far off. In fact, that's what we have been doing so far in this video. But truth be told, looking at a company's market capitalization is just one of the many available strategies, and a good investor needs to understand this. In fact, let me present a couple of examples to press this point. Let's examine HPCL, the Hindustan Petroleum Corporation Limited. Now, this company is currently ranked 120 in terms of market capitalization, in terms of its size, which per the SEBI definition makes it a mid-cap company. However, if we sort our entire database on the basis of a different strategy, let's say we sorted on the basis of the profits generated, then HPCL is no longer the 120th company, but is now the 19th largest listed company in India. Again, if we were to consider revenue as a preferred metric, then HPCL does even better and becomes India's 8th largest company. So depending on the strategy, the company per our own definition can be a small cap, mid cap, or large cap, or even a mega large cap company. And there are many examples like this. Take Tata Motors, for instance, which is the 42nd largest listed company in India as per the market capitalization. But it is also the 6th largest company from a revenue standpoint. But when it comes to profits, Tata Motors has a ranking of 5,000 something with a disconcerting loss of 13,400 crores, making it one of the 5 least profitable Indian companies. So remember, capitalization is just one strategy, and there are many other metrics and characteristics that can be used to categorize companies and improve one's investing decisions. In this section of the video, we'll do a sort of cross-sectional analysis. What I mean is we'll tag the nifty companies as large, mid, and small caps per their size, but more importantly, we'll examine them in relation to some other characteristics like their financial statements, growth, and profitability metrics. Let's start with the financial statements, and for the purpose of this study, we'll work with the top 500 nifty companies. The data here shows the dominance of large caps in most areas like revenue, profits, capital expenditure, operating cash flows, and this was largely expected. But the same data becomes a lot more interesting when we cross-reference the data sets. For example, instead of taking the top 100 companies by market capitalization, what happens if we sort the top 100 companies by its profits? Well, here's what we found. Firstly, unlike the top 100 MCAP companies, which contributed 76% of the profits, the top 100 most profitable companies contributed an astonishing 96% of all the net profits generated by the Nifty 500 companies, and that's big. Secondly, we find that the size of the company has only a moderate correlation to the size of its profits. I mean, look at this data. Of the top 100 most profitable companies, 30 companies are actually mid-caps as per their capitalization, so they are outside the top 100 per their market cap running. And even more surprisingly, there are 5 small-cap companies in that list of India's 100 most profitable companies. If you're curious to which are these 5 companies, here they are. NLC India, CESC Limited, the Housing and Urban Development Corporation, that's HUDCO, SJVN Limited, which is into renewable energy, and the Chambal Fertilizer and Chemicals Limited. Presently, these 5 companies have a market cap of between 7,000 to 14,000 crores, and all these companies deliver profits in the range of 1,300 to 1,600 crores as per the previous financial year. So the point that is coming out here is that size may not be the numero uno criteria for every occasion. But what is a definite criteria to any investor I talk to is that everyone wants to invest in growing companies. However, there are some perceptions here. Some investors feel that large cap companies grow faster than others because they have bigger brands, better pricing, can withstand competition, and operate with a high level of professionalism. But there are other investors who feel it's the mid-cap and small-cap companies which have a higher chance at it on account of them being lean, nimble, and hungry for growth. It's a question of perceptions, so we left it to the data, and here's what the numbers say. On the revenue front, and this might be a bit of a disappointment, but 3 out of every 5 companies have registered an annual growth rate of less than 10%. More specifically, this seems to be the case with small cap companies more than the large and mid cap ones. In fact, as an aggregate, the average Indian company has grown in the high single digit to low double digit range, and only 12 to 15% of the companies have delivered at least 20% growth in terms of revenue. From a profitability point of view, we see a slightly more promising trend with half the companies delivering more than 10% growth. But having said this, it is good to see that 1 in every 5 companies has shown an operating profit CAGR of 20% over the last 5 years, in spite of it having been a not that rosy period from a broader Indian economy. And finally, we pan our attention to the return on equity metric, which gives us a good idea of how efficiently a company is generating returns for its shareholders. The data here shows that about 70% of Indian companies across capitalizations generate an ROE of over 10%. In fact, it is only when we seek companies with an ROE of over 20% do we start seeing a higher proportion of large cap and mid cap companies, with over 35% of large caps and 30% of mid caps generating an ROE of 20% plus. Now, in addition to the metrics we have examined, like the ROE, growth rates, cash flow, profits, revenue, etc., there are many other flagpoles that can be used. There are many ratios like the P ratio, the price to book value ratio, debt equity ratio, etc., which are commonly used by everyday investors. But then there are also more sophisticated metrics like momentum scores, value scores, earnings quality, etc., which all come together to give a more meaningful shape to the categorization of companies, which extends beyond market capitalization. We've all watched and listened to many experts who say young investors should put their money in mid-cap and small-cap funds. But what they really mean is that people in their 20s and 30s should not shy away from taking that little extra volatility by investing in companies that can potentially offer higher returns on account of a better ROE, a superior business model, and stronger growth potential. Now, the study we did today showcases that one need not be boxed within a mid-cap or small-cap environment, and that there are potential winners across the entire universe of listed companies. We see 3 approaches that can be employed to pick up these selected companies. The first is the direct one, that is, you get yourself a trading account and buy individual stocks that meet your criteria. And if you haven't watched it yet, then we would recommend a wonderful video that we have on this, where DSP Mutual Fund's Kalpen Parekh prescribes a 3-step process to identify undervalued stocks. The second approach is by investing in active mutual funds. Now, you will need to zero in on a fund, or rather identify a fund manager who works on a style that's more suited to you. It requires some work to figure this out, and we have 2 videos on how that process might work for you, where we reverse engineered the stock picking style of the HDFC Top 100 Fund and the Axis Long-Term Equity Fund. And the third way of you getting what you want, and this is an approach that is getting more and more popular, is what we call as factor indexing. You can read more about it on the internet, but very quickly, a factor index looks to identify stocks with specific characteristics. And these are a lot like the ones we discussed, like profitability, valuation, growth, risk, momentum, value, etc. In fact, on the ETMoney channel, we have explained some funds that use one or multiple factors, and it's a term you will continue to hear from our team at ETMoney as we look to introduce our newest offering in a few short weeks that takes in the best of these factors along with asset allocation, rebalancing, and personalization to give our investors a complete investing experience. And with this, we come to the end of this video. I hope you liked some of the insights that were presented here, and this video was our attempt to help view investing beyond the convenient structure of capitalization that we all seem bottled into. If you liked this video, then tap on that like button, share it with your friends, and do subscribe to the ETMoney YouTube channel for more insightful videos. Thank you for your time, and I look forward to catching up with you next week with another insightful video. Until then.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.